The market just dropped 10%. And right now, millions of people are about to make the most expensive mistake of their lives. They're opening their brokerage app, they're seeing red everywhere, and their finger is hovering over the sell button. Here's what they don't know. Selling during a 10% drop has historically cost investors more than the drop itself. Way more. We're talking hundreds of thousands of dollars over a lifetime. Gone. Not because the market crashed, but because of what they did next. Let me put this in real numbers so it hits home. If you have $50,000 in your retirement account, a 10% drop means you just lost $5,000 on paper. If you have $100,000, that's $10,000 gone. If you're sitting on $250,000, $25,000 just vanished from your screen. Those numbers hurt, I get it. But here's the thing, you haven't actually lost anything yet. Those losses only become real when you sell. Right now, it's just a number on a screen. What you do next matters. It determines whether this stays a temporary dip or becomes a permanent scar. By the end of this video, you'll have a 5-step checklist. It covers exactly what to do when the market falls 10%. No guessing, no panic, just a clear plan you can screenshot and save for the next time the market turns red. And I'll show you the real math on what panic selling actually costs, including a $7,500 gap from a single $10,000 investment, and what that gap looks like at $100,000. Quick note, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Now, let's talk about why this moment matters so much. Here's a stat that might change the way you think about crashes forever. 76% of the market's best single days happened during bear markets, or in the first 2 months of a new bull market. Read that again. The biggest up days happen right in the middle of the scariest down periods. So when people panic sell during a crash, they don't just avoid the bad days, they miss the best days too. And those best days, they're worth almost everything. Miss just the 10 best trading days over 30 years, your returns get cut in half. Miss the best 30 days, your returns dropped by 84%. And here's the part that really bakes your brain. The best days and the worst days tend to cluster together. They show up within days of each other. 7 of the 10 best market days in 20 years, they happened within 2 weeks of the worst days. So if you sold on a bad day, you almost certainly missed the rebound right after it. Think about 2020. The market crashed hard because of the pandemic. Some people sold everything. And within 12 months, the market was hitting new all-time highs. The people who sold locked in their losses. The people who held were back to even, and then some within a year. That's how corrections work. They're painful going in, rewarding coming out, but only if you're still in the game. So let's get into the checklist. 5 steps, in order. Do these and you'll be ahead of 90% of investors during any market drop. Step 1, do not sell. I know, it sounds too simple, but this single step is where most people fail. Here's what the data says. The research firm DALBAR has studied investor behavior for over 30 years. Their latest report covers 2024. The average investor earned about 16.5%. Sounds decent, right? The market returned over 25% that same year. That's an 8.5% gap. Not because they picked bad investments, because they bought and sold at the wrong times. Let me put that in dollars. If you had $100,000 invested at the start of that year and you matched the market, you'd have $125,000 by December. But the average investor? They ended with about $116,500. That's an $8,500 gap in one single year from behavior alone. And that gap compounds. Over 20 years, that behavior gap is brutal. It can turn a $100,000 portfolio into just $345,000 instead of over $700,000. The difference? $371,000. Gone. Not from bad stocks, from bad timing. And here's the wild part. DALBAR also tracks something called the guess right ratio. It measures how often investors correctly time their moves in and out of the market. In 2024, investors guessed right only 25% of the time. That's 1 out of 4. You get better odds flipping a coin. And a single poorly timed move can erase months of gains. So why do smart people keep doing this? Because selling feels like doing something. When the market is dropping, doing nothing feels reckless. It feels irresponsible. But the data is clear. Doing nothing during a crash is almost always the right move. The hardest move, but the right one. So step 1 is simple. When the market drops 10%, do not touch the sell button. Step 2, check your emergency fund. Here's why people sell during a crash. It's rarely because they read some chart or did the math. They sell because they're scared they'll need the money. A job loss, a medical bill, a car repair. When the market drops, fear of real-life emergencies gets louder. That's why before you do anything with your portfolio, you check your cash cushion. Do you have 3 to 6 months of living expenses in a savings account? Let's say your monthly expenses are $4,000. Your minimum emergency fund is $12,000. Your target is $24,000. If you have that cash cushion, you don't need to sell investments to cover surprises. Your portfolio can ride the storm. If you don't have it yet, that's okay. Your next dollar should go there first, not into the market, and definitely not out of it. And here's a quick tip. Your emergency fund doesn't belong in a regular checking account earning nothing. Put it in a high-yield savings account. Right now, many high-yield savings accounts are paying 4 to 5% interest. Your $12,000 emergency fund? It could earn about $500 a year just sitting there. It's not exciting, it's safe, it's liquid. And it keeps your hands off your investments when things get scary. Think of it this way. Your emergency fund isn't just a safety net, it's an anti-panic device. When you can cover months of bills without touching your portfolio, those red numbers stop being so scary. And coming up in a minute, I'll show you something wild. 2 people invest the same $10,000 during a crash. 20 years later, one has $7,500 more. And at scale, that gap is massive. But first, step 3. Step 3, review your timeline, not your balance. Here's the most important question during any market drop. When do you actually need this money? If you're 25 and investing for retirement at 65, you have 40 years. A 10% drop today is a speed bump on a cross-country road trip. If you're 60 and planning to retire next year, the same drop hits differently. And that's where something called sequence of returns risk comes in. Let me explain that in plain English. Sequence of returns risk means that when you experience bad returns at the beginning of retirement, right when you start withdrawing money, it does far more damage than if those same bad returns happened later. Picture 2 people. Both retire with $1 million. Both withdraw $50,000 a year. Both get the same average return over 18 years. The only difference? One gets hit with a negative 15% return in the first 2 years. The other gets that same hit in years 10 and 11. The person who got hit early, they run out of money years sooner. The person who got hit later, they're fine. Same market, same returns, different sequence. Wildly different result. Now here's the good news. If you're more than 5 years from needing this money, sequence risk barely applies to you. Time is your shield. But what if you're close to retirement? What if you're 58 or 62? First, don't panic. This is why financial planners recommend shifting toward bonds and cash as retirement gets closer. If you've already made that shift, your bonds and cash are your buffer right now. You can live off those while your stocks recover. If you haven't made that shift yet, that's okay. This is a reminder, not a reason to sell. Talk to a financial professional about your specific mix. Now let's talk about why this matters specifically right now. This year has a lot of noise: tariffs, geopolitical conflict, interest rate uncertainty, midterm elections coming up in November. Here's a stat that explains the volatility. Since 1957, midterm election years have seen a correction 70% of the time. 70%. What's happening right now isn't unusual, it's almost expected. But here's the flip side. The 6 months after midterm elections have historically been the strongest stretch in the entire 4-year cycle. The average gain in those 6 months? About 14%. So the playbook is clear. The storm is loud, but the calm after it tends to be very profitable. 27. That's how many times the market has dropped 10% or more since 1974. 27 times in about 50 years. That's roughly 1 every 2 years. Out of those 27 corrections, only 6 turned into a full bear market. Just 6. So the odds of a 10% drop turning into something truly ugly? About 1 in 5. The odds of it recovering? About 4 in 5. History doesn't guarantee anything, but the math leans heavily in favor of the patient investor. Step 4. If you have cash, add to your investments. This is the step that separates good investors from great ones. When stocks drop 10%, everything is on sale. Not on fire, on sale. Think about it this way. If your favorite store had a 20% off sale, would you return everything you already bought? Of course not. You'd buy more. But that's exactly what most people do with stocks. They sell low because it feels scary. They buy high because it feels safe. Here's a real numbers example. Let's say you invest $10,000 in a broad market index fund. If you invest it when the market is at its peak and someone else invests the same $10,000 after a 10% drop, that second person owns more shares at a lower price. Over 20 years at average market returns, that 10% entry difference turns into $7,500 more on $10,000 invested. $7,500, same amount invested, different timing. Let me make this even more concrete. Let's say the market is at an all-time high. You buy an S&P 500 index fund with $10,000. Your buddy waits. The market drops 10%. Then your buddy puts in the same $10,000. You both hold for 20 years. You both earn the historical average of about 10% per year from that point forward. After 20 years, your $10,000 is worth about $67,000. Your buddy's $10,000, bought at that 10% discount, is worth about $74,000. That $7,000 gap exists just because of when they bought in. Now scale that up. If you had a $100,000 portfolio, that same 10% entry gap becomes $75,000 over 20 years. The math is the same, the stakes just get bigger. Now, I'm not saying try to time the exact bottom, nobody can do that. But if you have cash sitting in savings earning 4%, and the market just went on a 10% discount, it's worth asking the question, could some of that cash work harder somewhere else? Here's a simple rule for how much to invest during a dip. First, your emergency fund stays completely untouched. That's non-negotiable. Second, any cash you might need in the next 3 to 5 years stays in savings. Third, anything beyond that is fair game for investing during a correction. Maybe that's an extra $2,000, maybe it's $500, maybe it's $50. The amount doesn't matter. What matters is you're buying when others are running. And coming up, I'll show you the common mistake that costs investors the most during a downturn, plus the dead simple fix. But first, step 5. Step 5. Automate and walk away. This is the secret weapon, and it's boring on purpose. Set up automatic contributions to your investment account. Every paycheck, same amount, rain or shine, mark it up or mark it down. This strategy has a name. It's called dollar cost averaging. Dollar cost averaging means you invest a fixed amount on a regular schedule, no matter what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Let me show you why this is so powerful during a correction. Say you invest $500 every month into an index fund. In month 1, the share price is $50. Your $500 buys 10 shares. In month 2, the market drops. The share price falls to $40. Your $500 buys 12.5 shares. In month 3, it drops again. $35 per share. Now your $500 buys over 14 shares. In month 4, the market bounces back, $45 a share. Your $500 buys about 11 shares. After 4 months, you've invested $2,000. And you own almost 48 shares at an average cost of about $42 per share. Waited until the market recovered? 2,000 at $45 per share gets you only 44 shares. More shares, lower average cost, no guessing required. And the best part? Most brokerages let you set this up in about 2 minutes. Go to your account settings, find automatic investments, pick your fund, set your amount, pick your frequency, done. You're not checking headlines, you're not watching charts, you're not refreshing your app every 15 minutes. You set it, you forget it, you let time do the work. And here's why that matters right now. Remember, the average investor underperforms the market by huge margins year after year, not because they pick the wrong funds, because they react to the wrong emotions. Now here's the part most people skip. Don't skip this. The number one mistake people make during a market drop isn't selling. That's the number 2 mistake. The number 1 mistake is watching. Checking your portfolio every day during a downturn is like stepping on the scale every hour during a diet. The number is going to bounce around, and every bounce is going to mess with your head. Studies show that the more frequently investors check their portfolios, the more likely they are to make emotional trades. And those emotional trades are what create that massive gap between investor returns and market returns. So here's the fix, and it takes 30 seconds. Turn off push notifications from your brokerage app. Delete the app from your home screen. Set your automatic contributions and then don't log in for 30 days. 30 days, that's it. Let the checklist do the thinking so your emotions don't have to. Now let's address the elephant in the room. I know what you're thinking. Okay, but what if the market doesn't recover? What if this time is different? Fair question. Let's look at it honestly. Could the market drop another 10% from here? Absolutely, it's possible. Could it drop 20? Sure, it's happened before. But here's what the history tells us. After the crash of 2008, the worst financial crisis since the Great Depression, the market recovered fully within about 5 years, and then went on to triple over the next decade. After the pandemic crash of 2020, it recovered in about 6 months. After the tariff scare of 2025, the market ended the year up over 16%. Every single one of those crashes felt like the end of the world while it was happening. Headlines were screaming, experts were predicting doom, your coworkers were talking about selling everything. And every single time, the people who followed a plan like this checklist came out ahead. Now, does past performance guarantee future results? No. It never does. That's why you have an emergency fund. That's why you check your timeline. But here's the real question. If you sell today, when do you buy back in? Think about it. You sell because you're scared. Then you sit in cash. The market drops more. You feel smart. Then the market bounces 10% in 1 week. You feel nervous. It bounces another 5%. You think it's too late to buy back in. Now you're sitting in cash while the market is recovering without you. That's exactly how the average investor ends up earning 16% when the market earns 25%. The hardest part of investing isn't picking the right fund, it's sitting still when everything tells you to move. Let's bring it all together. Here's your complete 10% drop checklist. Screenshot this right now. Step 1, do not sell. The drop is temporary. Selling makes it permanent. Step 2, check your emergency fund. 3 to 6 months of expenses in cash keeps you from panic selling. Step 3, review your timeline, not your balance. If retirement is more than 5 years away, this drop is noise. Step 4, if you have extra cash, consider investing more. A 10% drop means a 10% discount. Step 5, automate and walk away. Dollar cost average. Turn off notifications. Check back in 30 days. That's the checklist. 5 steps. No panic required. Here's what I want you to remember. The market has dropped 10% or more 27 times since 1974. And every single time, every time, it eventually came back higher than before. The people who won weren't the ones who predicted the bottom. They were the ones who stayed in the game. The average return of the market over the last century is about 10% per year. But you only get that return if you're invested. Selling during a crash doesn't protect you. It locks in your loss and kicks you out right before the recovery starts. Your only job during a market drop is to follow the checklist. That's the move. Money made simple. If this was useful, you'll want to see how to build a bulletproof emergency fund, the thing that makes this entire checklist possible. I'll link it right here.